Welcome to the Prudent Pulse. Now, yesterday, the 30-year Treasury yield reached 5.33%, hitting its highest level since June 2007. Now, what this essentially means is that long-dated Treasury bonds are selling off hard, and this is happening for four key reasons. First, the federal government recorded a $432 billion deficit in July. That was its worst level since March of 21. And the total deficit for the first 10 months of this fiscal year has already surpassed the total federal shortfall in 2025. Second, inflation remains stubbornly high. July CPI came in at 3.4%, and with Brent crude back around $90 a barrel, continued upward pressure on inflation is to be expected. Third, there is significant long-dated bond supply entering the market. Wall Street analysts estimate around $300 billion of investment-grade bond issuance tied to data center production this year. These long-dated bonds are competing for similar duration as the 30-year treasuries. And fourth, traditional bond buyers are stepping back. Japan, which is the largest foreign holder of U.S. treasuries, has been selling off tens of billions of dollars of U.S. government bonds as Japanese investors rotate out of treasuries into their very own Japanese government bonds. Now, a key point worth noting. This move higher is primarily a term premium story. Following weak July jobs and soft retail sales, the bond market has actually scaled back Fed rate hike expectations, and shorter-dated Treasury yields have actually been falling. This sell-off is happening at the long end of the yield curve, and investors will be watching whether the 30-year yield takes out the June 2007 high of 5.44%, which is now within striking distance. And that's the Prudent Pulse.